You ever think about buying dividend stocks? Tech has rolled over. It's had a rough year. Maybe you're thinking about some dividends. We got the 10-year note roughly trading at 3.8. Maybe we go after some income. So Mr. Dan Bird has gone out and done a scan for us on dividend stocks, and we are going to take a look at it. How you doing, buddy?
I'm doing well. Yes, we talked about this before. You said you wanted to build a portfolio of some solid companies that you don't have to really worry about. Just let it ride. One way to do that is blue chip names that pay dividends.
Yeah.
And then reinvest the dividends.
That's exactly what I want to do. I've told my channel I want to put $50,000 to work into dividend-based stocks, and I will, as you said, reinvest the dividends. Absolutely.
Yeah, and that can be automatic.
It is.
Right. So dividends will automatically reinvest if you set it up that way.
Correct.
Or you can have them pay you the dividend if you want to do it that way too.
It's up to you.
Now I thought I had an annual New Year's resolution for stock trading in my newsletter, but I didn't. I actually put it on LinkedIn.
Ah, okay. All right.
That's where I put it. So if anybody goes and finds me on LinkedIn, I actually post things occasionally with charts and things on LinkedIn. It's not nearly as complete as my newsletter, but that's out there. Let me share my newsletter real quick before we get started. So if you're interested, send me an email to breakpointtrading@gmail.com, and I'll put you on the list. I'll send you this week's newsletter, and if you want it to be taken off, just let me know. No big deal. I usually try to find some cartoons to stick in there as well.
Someday, all of this will be yours.
Right.
That's hilarious.
That's more true than comical, unfortunately.
No, I agree. I agree.
So is the one on the right. Santa saying, thanks to me, people all over the world will get millions this Christmas. And here's $600 for you. The guy says, hey, that's my checkbook.
Yeah, exactly. Yeah.
That's Congress.
Yep.
Signing a $1.7 trillion omnibus bill.
Yeah.
1.7 trillion.
Yeah. We don't talk billions anymore. Now we talk trillions.
How many billions are in 1 trillion?
1,000.
1,000 billions are in 1 trillion.
Yeah, that's crazy.
So 1.7 trillion is 1,700 billions.
Billions, yeah.
And how many millions are in a billion?
Okay. All right. You're gonna hurt my head.
There's 1,000 millions in a billion.
Yeah, you're gonna hurt my head.
Just for those folks out there that think, well, it's 1.7. That's not very big.
That's a lot of zeros, man. That's a lot of zeros.
A lot of thousands.
Yeah, we're going to talk about the best dividend stocks. You did a scan, so set it up for us. What do you got?
I did. Let me show you. I did this in VectorVest. So this is one of the cool things about VectorVest. First of all, they have all these searches already set up, and you can create your own. I've got a lot of my own created. But one of them, this is under their retirement folder. One of them is blue chip dividend payers.
Okay.
All right. So their criteria for this is they're looking for stocks that are in the Dow Jones Transportation, Dow Jones Utility, and the S&P 500.
Okay, makes sense.
All right. So those are all the big players are in there. The next criteria is they want a dividend yield, an annual yield of 3% or higher.
Okay.
On the dividend. And then they're looking for stocks in the DRIP watch list. DRIP, for those that don't know what that is Dividend Reinvestment Program.
Okay.
All right, so these are stocks that reinvest the dividends, and it's looking at over 10 years.
Okay.
So over a 10-year period. And then finally, dividend safety. So they want not just high-paying dividends, because what you'll find is you can find companies that are paying dividends of 20%.
Sure.
18, 19% per year. But those dividends oftentimes are not very safe.
No, they get the sign of being cut.
They could easily not only be cut, they could easily just disappear.
Yeah, go to zero. Yep.
Right. So we're looking for dividend safety as well. And this is on a scale of 0 to 100. So this is looking for dividend safety in the upper 50%. Of all of these stocks here that we've just selected. Okay.
Okay.
And then when I run that, this is what I get. These are all the stocks that I get. Now, what we can do just for fun, I'm going to change the date to run this to December of last year. December 31st of last year. And let's see what stocks it gave me.
Oh, I see what you're doing. Okay.
All right. So these are the stocks it gave me last year. Now,
Last
these are
December. Okay.
last December 31st. So these are ranked by growth times dividend growth. So earnings growth times dividend growth.
Look at
That's
that.
how it
A
ranks. That's
lot
how it
of
ranks.
energy.
A lot of energy in here. Yeah, and this is before energy really started taking off,
Oh, yeah.
right? So the next thing I can do, so that's from last year. That's last year's numbers. So what I can do is I can do a quick test on these. Let's see how they actually perform. So I can quick test from the date last December 31st to this December 30th.
Okay.
All right.
Yep.
And I can compare that to the S&P down below. So the S&P for that period, for the last year, lost almost 20%. Okay. These top 10 dividend payers, and actually let me do just the top 10. Or I'll quick test the top 10. So just the top 10. So the top 10 returned 25%
Look at that.
when the market lost 20%. Okay.
Okay. Yep.
Let's go back the year before. Let's go to December of 2020.
It's nice that they do this.
Yeah, it's one of the cool things about VectorVest. So December of 2020, I'll run the same search, and that's what I get. Let's do the top 10. So there's the top 10 from 2 years ago. Now remember, 2021 was a great year for growth stocks. Remember?
Yep.
So you would expect these kind of stocks to not perform as well. Right?
Yeah, I would agree.
These are more value stocks.
Correct.
So let's do a quick test on these. And now I want to run this from 2020, not till this year, but I want to run it to the end of last year, December 31st, and see how they did for the full year. All right, you follow me? So I'm running.
I do.
I'm running the back test from December 2020 to December 2021. So I run that test, and now we see that the S&P, returned almost 27%, which you would expect because it was a lot of growth in that year.
Yeah.
These didn't outperform the S&P, but they still returned a pretty decent 15%.
Now, does that include dividend reinvestment, or is that just stock?
No, that's just a straight dividend.
Say that again.
Well, yes, it does include dividend reinvestment because we're also
we're
narrowing this down to the dividend reinvestment program.
So it's not just stocks; it's the stock appreciation
it's
plus
not just
the
return
dividend
on the stock. Right.
Got it. That's what I would hope. So it's apples to apples. Okay.
Right.
All right. So that would make sense.
All right. So it shows that, in a really good year for the S&P, it doesn't outperform it, but it still gives you a pretty decent return.
Yeah.
And in a year when the S&P lost 20%, it still returned, 25%.
Cool.
Actually returned much better than the S&P. So, So now let's go back and run that search again for this last December 30th. December 30th, 22. And there's what we get.
Interesting.
Those are the stocks. I actually went through this exercise in my newsletter. I actually showed all 3 of these years, just like I showed you here. And I showed these 10 stocks in my newsletter. So you don't have to write them down or do a screenshot. If you get my newsletter, you'll have all this in there.
Okay.
All right. Now, the next question is, what do we do with this?
Yeah.
what you could do, and that with those searches that I just did, we actually just bought them all on the first day of the year
Mm-hmm.
and just didn't touch them.
Right.
Let them run. And if I go back and do this again real quick. If I run this search from last year again, and then I do this quick test, you can see even though it returned 25% for the whole portfolio, meaning assuming you bought them all and didn't touch them,
Mm-hmm.
right? What you'll notice is a couple of these did not really perform very well.
No.
Yeah, this had a 21% loss and this had a 23% loss. So if you're using money management techniques
Mm-hmm.
and stops, now you
Yeah,
probably want to give these a little bit more leeway than you
Sure.
normally would if you're trading.
But still use stops so you don't get blown out on the big
Right.
losers.
So if
Okay.
you're using a 10% or let's say a 12% stop or even a 15% stop,
Mm-hmm.
because this is how they ended up at the end of the year. You can see MPC up here returned 82%.
Mm-hmm.
But they could have gone down 10% at some point in the year.
Right.
You don't necessarily want to get stopped out.
Right. Okay.
But that doesn't mean you want to hold this, and let them have 21% losses. The other consideration is you might want to take a look at each one of them and decide when to get in rather
Sure.
than just buying them all right away up front, which I'll show you something in a second about that.
Okay.
Now this MPC for 82% for the year, just out of curiosity, let's look at the chart. I'll do a 1-year chart. So started off down here, went up 82%, but you can see this area right here,
Mm-hmm.
where it had a big sell-off.
Yep.
And then started back up again. So there's a variety of different ways you could do it. I always like to have the 8-day moving average, the 21-day, and the 50-day.
Mm-hmm.
So you could say if the 8-day goes below the 21, then I'm getting out.
Sure.
And if it goes back above the 21, I get back in.
So you missed that pain there.
You miss that pain right there, or you don't miss all of it, but you miss some of it right there. And you might get out here, but you'd have to look at the rest of it. Maybe get out and in right here. So you might lose a little bit right in there.
Mm-hmm.
And then you would get out again here earlier this year.
Okay.
So that 82% would end up being higher than that.
Mm-hmm.
If you did that, or you could just let the whole thing run.
Yeah.
If we look at the one that lost 23%, Comerica, this is a bank.
Mm-hmm.
You can see it started off over here and it ended up lower.
Yeah.
So again, in this case, you might not even get in until it crosses above, the purple crosses above the blue.
Mm-hmm.
And then stay in until it crosses back over up here.
Okay.
And then you might have stayed out the whole year because it never went back above the 50-day.
Yeah.
So in this case, you would have made money. You wouldn't have lost 23%.
Right.
But using some of these kind of techniques, once it goes below the 50-day, you would not buy it back until it goes back above it.
Got it. Okay.
All right. So those are different ways to be able to do this, but this at least gives you a starting place.
Mm-hmm.
If there's some in here that you really like ExxonMobil, let's take that one. ExxonMobil is, pretty much a pretty steady stock.
Mm-hmm.
It had a nice little run going up. But if you're just in it for the dividends and one that you just want to hang on to, not worry about,
kind of boring.
that might be one you just buy and just leave it alone.
Yeah.
So each of these, it's really up to each individual how they want to do it.
Yeah.
And how
not financial advice, just do your own research.
Not financial advice, just an idea. It also gives folks a kind of a sense for what VectorVest can do for you.
Cool. I like
it. Which is kind of cool. Now I did create a portfolio for these right here.
Oh, nice.
So these are the dividend payers. So you see 12/30 was the purchase date. We can track this through the year to see how it does.
Why not?
right?
Yep.
So some of these have buys. So you got Broadcom with a buy. This is a utility right here, and Pfizer with a buy.
Okay.
Utility sector, by the way, it looks actually like it's getting ready to trend higher.
Which would, yeah, pretty good for a recession, to recessionary indicator.
Right, exactly. So you might want to consider the sectors that these are in, which shows you the industries over here. Banks, petroleum, utility. There's a utility there. That's that one that's got a buy. Insurance, right?
Yep.
Just for fun, I did this for technology stocks. This is back October of last year, when somebody on LinkedIn posted a bunch of technology names and said, you know, if you want to know which ones people want to work for.
Oh, 65%.
Down 65%. Yeah. This is on October 8th of 21.
My God.
If you just bought them then and just
they're all down.
Every single one of them are down. The worst one is Twilio and the best one is ServiceNow.
That's amazing. How about the good old ARK I see there?
Yeah, ARK up here. We did that one on February of 22.
Yeah.
They're still down 45%.
Is everything down? Every stock?
Yeah, everyone's down.
Every one of her stocks.
No, one of them's up. This Signify Health, which actually
she's got one.
They got bought out. And I have not adjusted these since this date. She's sold some and added others. I haven't adjusted it. So this is just assuming you just bought whatever was in the ARK.
Yeah, that's funny.
Or you're trying to duplicate the ARK and you bought the same names, but you didn't buy her fund. Yeah. Then her fund is probably not that bad, but it's still pretty bad.
It's bad. It's bad.
All right, so let's go over here to stock charts. Sure. So VectorVest is what I use for fundamental analysis. So I use that to find good blue chip dividend payers. Okay. So I like VectorVest for doing searches on fundamentals of the companies. Okay. Whereas stock charts I like for the technicals. So these are the same blue chip dividend payers, same ones that I just showed you. Yep. I can look at a summary to see which ones are doing the best on Friday. So Exxon was the best on Friday. I can see how they did over the last month. And Broadcom and Pfizer. These are the three, by the way, that were buys. Coincidentally, these were the three that were buys in VectorVest. Remember that? Yep. Pfizer, the utility, and Broadcom. And they're also the ones that did the best over the last month. I can see how they did over 3 months, over six months, and then year to date. Cool. All right, so Exxon, these are all energy stocks as you would expect to see. Yeah. But more importantly, I can look at the charts for each of these. So now, if I wanted to use my charting techniques to decide when to buy one of these, I could do it this way. So here's Broadcom. Broadcom has a nice trend higher. It's staying above all of its moving averages. The momentum looks like it's turning up. The volume is down, but this is over a holiday week, so it's not too surprising. So actually, Broadcom looks pretty decent. Here's Comerica. Comerica is below its 50-day moving average, so I might want to wait on that one. Yep. Although it looks like it's starting to trend higher, but it's below its 200-day, which I don't really like that. Okay. So if you wanted to get in at a lower price on a high-paying dividend or a blue chip dividend stock, this might be the time to do it if you wanted to take a little more risk. If you wanted to wait for it to prove itself and get above the 200-day, here's Chevron. Chevron looks pretty good. Here's Fifth Third Bank. This one is debatable. Below its 200, actually it's below almost all of its moving averages. So I'm not sure that would be a good one unless you wanted to try to catch a bottom on bank stocks. That's regional banking. Here's the utility. The utility sector looks like it's getting ready to take off. So that's another thing that you might do, is look at the sector that it's in
Right.
and make a decision. So this one here, if it gets above this 200 day, which is at 62.71. So if this closes above 63 or so, this might be a good one to add. Here's Pfizer. Pfizer is above all of its moving averages, including the 200 and the 50. So Pfizer might be a good one. Here's Principal Financial. This is in the banking sector. Again, it's below all its moving averages, so that one doesn't look so good. It's above the 200. PNC Financial, another bank. Valero Energy, it's another energy stock, just getting ready to move above the 50-day. But the momentum indicators are overbought right now. So this is one you might want to wait for it to pull back some. If this is one you might like because of the dividend, then you might put in a purchase down here at 120 and see if it will pull back to 120 and then let it execute. And Exxon. Exxon had a nice day on Friday. It's above all of its moving averages. It's a little bit overbought, but you can see here it can stay overbought for quite a while. Here's the RSI up here. Stays high for a while. The RSI is trending up. So Exxon again is another one. It's closed at 110.30 on Friday. This might be a good one to buy right now, or you could put in an order right at the 21-day moving average, which is at 108 basically, and see if it'll come back to that.
Cool.
But that's a way, to look at dividend stocks and then use technical analysis to determine whether you want to get in or get out. Or
yeah, I like the idea of the scan, kind of testing a thesis. I'll call that the macro level,
right,
and then coming in and doing a micro on the individual stocks. That's fun. That's what you've been teaching us. You have a playlist on the channel that goes back a year now. We've been doing this over a year,
right.
So lots of stuff people can watch.
Right, and if you want to do an even more thorough analysis, is you would look at the sectors and the industry groups for each one of those and see what those look like, because typically 40% of a stock's move is based on its industry group.
Yeah.
So if you're trying to buy a stock that looks like it's moving up, but its industry group is doing terrible.
Right.
In fact, I'll give you a good example. Go back to Tesla again. Right? Tesla's moving up right here.
Yeah.
But this purple right here is Tesla versus the S&P.
Oh, wow.
And if you want to see how Tesla's done versus its own industry, so here's the industry group, the red one that Tesla is in. This is automakers. It's had a horrible year. And Tesla in the blue right here, just compared to automakers it's themselves have been terrible, but Tesla has underperformed a terrible group.
Ouch.
Right? And then down here is automakers versus the consumer discretionary, which has also had a terrible year. And consumer discretionary is the yellow one down here versus the S&P. All of these look terrible. But the most important ones that I look at are the top two, the red and the blue. What is the industry group doing? And how is Tesla performing versus its industry group? Sometimes you find an industry group that hasn't been doing too well, but you find a stock that's outperforming its own industry group. It's still a risk because, like I said, 40% of a stock move is in its industry group.
Very cool. Well, Dan, I appreciate you doing this for us each and every week. Thank you for doing this dividend scan for me personally. It was very helpful. Show your newsletter one more time.
Sure. And if you want to see those, they're in the newsletter. Just send me a note to breakpointtrading@gmail.com. And I will send you last week's newsletter and I'll add you to the list for next week. Here's the newsletter itself.
Lots
down
of stuff
here
in there. Yeah.
Right. Down here is 2 years ago. And now this is last year, 25%. This is 2 years ago, 15%. And these are the ones for this year.
Very well done. Thank you for doing all that.
Those are the same ones that we just looked at. So those are right in the newsletter. So you don't have to write them down or anything. Just get the newsletter.
Awesome. Dan, thank you very much. We will talk next week.
You bet.
Mhm.